Good day, ladies and gentlemen. Thanks for joining us again for another monthly East Daily webinar, our monthly production stream for the month of October on this fine mid-October day. My name is Jack Weichsel. I'm going to be your host today and moderator, and also have some natural gas commentary for you. And I am joined by these fine gentlemen and lady right here. So, Gage, Dwan, thanks for being here.
Thanks for having me, Jack.
All right, Jackson,
Thanks, Jack.
thanks for checking in. Julian,
Thank you, Jack.
all right, and lastly, Oren. Well, not lastly, but right now, Oren, say hi. And then Maria.
Thank you, Jack.
Okay, cool. Very good. We like to keep it fairly light here, but we do have some fun things to talk about today. We're going to be focused in on the natural gas winter outlook, but then also happenings in crude and liquids, and also in capital markets, kind of over the next 5 to 6 months. So what's shaking this winter is kind of the theme of this webinar. First, a little commercial interruption, explainer of what we do. So, in short, East Daily can take you from the 5-foot wellhead level, using rig and well geoallocation assignments to tell you what's going on a system level, on a basin level, and then scooting up the value chain there, all the way down to demand. So we do that across commodities. So obviously our focus is on gas, crude, and liquids. You can't forecast those in a vacuum. So you have to do it all at once, which is what we do here and what we explain on these webinars. So let's get right down to it. Maria's going to come in and talk about some of the highlights that she noticed out of the upstream cross commodity markets this month. Then we'll get into our gas winter outlook. Oren's going to pitch in on a new pipeline. There's been so many pipeline startups and announcements over the past couple of weeks that we've got some new news for you as well. And then we'll get into crude, liquids, and capital markets, and wrap up very briefly with our regular production trends feature there. So let's do this. Maria, what do you got for us on kind of a macro outlook for 2025 production?
Yeah, so as you mentioned, we have the three commodities. For crude oil production, we are projecting an average of 13.6 million barrels per day. And the month-over-month variations are primarily stemmed from activity in the Bakken and Permian Basin. For nat gas, we expect dry gas production to average 107 BCF per day in 2025. And the Permian, Northeast, and North Latex regions continue to drive overall growth. And then lastly, but not least, NGLs production is forecast to average 7.4 million barrels per day in 2025, and the Northeast and the Permian remain the key sources of variation.
Okay, those are the swing basins. All right, and so what did you see this month just in terms of big basin movers?
Yeah, so overall price sensitivity remains a critical factor across all commodities. The Permian Basin continues to serve as the central driver whenever you're talking about oil, gas, or NGLs. For crude oil, as I mentioned, the Bakken is the primary source of change, and this is basically because we're seeing rigs rising to around 33, which boosts production across the multiple commodities, but you can see the most impact is it's crude. On the natural gas side, we see tier 2 basins such as the Anadarko and the Barnett continue to help balance the supply and demand dynamics, supported by improved well efficiencies. And then we also have the Northeast slightly up this month, and it's basically because there has been some announcements on like production, and you will also have an impact on seasonality, right?
Yeah, that's some healthy production for the Northeast, especially for October. rolling into winter at 36 instead of peaking at 36,
36, yeah.
which is a big difference.
And then we have also the NGLs, which is the green square. And you see the Permian is the primary key driver of the production change. And I think this is associated with our revision of the gas outlook, which we talked a little bit on the previous month
Right.
webinar.
Yep. I didn't know this, but I mean, Julian, half of all liquids production in the country comes out of the Permian.
That's right, Jake. Around half of NGL production is out of the Permian.
Jeez. Okay. All right. Well, I learned something today. Hopefully, you all will as well. Thank you, Maria.
Thank you, Jeff.
Let's go into the winter outlook. And I'm going to try to be direct into the point here. We are right around 107 BCF a day of current production. We might have slipped a little bit lower because of a kind of stagnant demand in September. But where do we need to be? Well, we need to be at 108, 109, even 110 BCF as we roll through winter. There's a heck of a lot of LNG feed gas demand coming online. And so that's why we need to get to those levels. 111 BCF a day by the time we close out, by the time we get to basically a year from now, next summer. We think a lot of these production gains will be driven by the Haynesville, right? Regardless of where you are in the basin, the break-even cost there, our forward price curve is above 375 in all instances. So that basin will be in the money. Inversely, right, Permian growth is no longer accelerating, especially in our post-Liberation Day, post-OPEC plus meeting there back in the spring, right? So we have that growth in the Permian slowing from 2.3 BCF in 2025 to just 0.9 BCF a day in 2026. But still, obviously, a lot of activity in the basin. Let's go straight to it, the actual winter outlook, without any further ado. What you're looking at in the graph in the bottom left is winter 25-26 versus winter 24-25. And you can see the production is going to be way up, right? And the main reason why that production is going to be way up is because you have about 3 BCF a day of incremental demand from Golden Pass, at least its first large-scale train, Corpus Christi, with a couple of its medium-sized trains coming online. I believe those are trains 4 and 5, possibly 6 as well. And then Plaquemines Phase 2, which are 18 smaller unit trains that will ramp up between now and March. So that's 3 BCF a day of extra LNG demand. When we look on the domestic side of things, right, things are a little calmer. We use a 10-year normal winter to basically, plot these out, right? And versus last winter, the big impact there is on residential and commercial demand. So we had a really cold February last winter, which drove up Rescom. And so when you're using a 10-year normal, you can see the offset there. Early indications for weather indicate a La Nina, a weak-ish La Nina conditions for this winter, which generally means warm southwest, southeast, and cold northwest plain state, northeast, right? So about a 50-50 split across the country. So really, you could go either way. However, we want to be, committal here. In our base forecast there, you can see in the graph on the right that we will end the winter with a surplus in storage to the 5-year average of about 87 BCF a day. BCF just straight up. If it were a cold winter, like we saw in 13-14, you'd run a deficit of 922 BCF a day. I don't see that happening. If you ended up in a 922 BCF deficit, prices for natural gas would be well above $15. And you would certainly elicit a production response before that could ever happen. Um, Conversely, right, if you had a warm winter like we saw 2 years ago in 23-24, then you would have a surplus of 552 BCF a day. That means $1.50 pricing. That means, EQT, expand, other producers shutting in just like they did in February and March of 2024. And so you'd also get a production response there. But, what's more likely? I think a normal winter is probably the most likely out of the three scenarios, but those other two scenarios act as good um, guardrails just to think about. So that's the winner. When I flash out, and you guys have seen this before, I imagine the longer term outlook there. What is driving gas production is gas demand, and to a large extent, that's uh, that's also dragging around the other two commodities there, just in terms of crude and NGLs, right? So, data centers, everybody likes to talk about, right? Jackson, you had a question from before.
Oh yeah, I was wondering, Jack, how are you getting to the 3.4 BCF a day of on grid and 1.2 BCF a day of off grid?
Yep. So that's the components of our 2030 outlook, right? Where is it going to be versus 25? I'm glad you asked the question because we need to be very clear here. This is an ISO Q tie-in queue constrained forecast, right? So in ISO tie-in queues across the country, there's about 130 gigawatts of natural gas projects, right? These are the ones that are in line to see if they, can get a tie-in to the grid, right? They're in line with a bunch of solar, some wind, and it's been taking the ISOs longer to review all these projects before they can get in. The new waiting time is about 4 years versus 2 years. So of that 130 gigawatts of gas, we assume about 25% will get in on time or within the time frame there. And that's historically greater than the average of 20% that usually get approved through ISO TIEQ process. But we feel like being aggressive because we think the power is needed. And anyway, so 25% of those 130 roughly gigawatts of gas in the queue is 3.4 BCF a day. Now, the other half of that, the 1.2 BCF a day, is going to be off grid. That calculus there can change a little bit because we think that, as data center developers become more comfortable with both midstream and upstream and vertically integrated, companies, there will be more and more instances of data centers that are in basin, that are using laterals direct to a single cycle turbine. Certainly in places like the Permian, and in parts of Wyoming, that makes sense. So good question, Jackson. I appreciate it. The 800-pound gorilla in the room, of course, is the 18.2 BCF a day of LNG feed gas that has been FID'd. Most recently with Port Arthur trains 3 and 4. So Oren's been all over that story. He's going to talk about how we feed all these beasts in just a minute. All right, so longer term, we got a heck of a lot of demand coming online. Longer term forecast, we maintain that the back half of 26 and most of 27 are largely oversold in the market. I don't know that the market or the forward curve has ever seen this much demand ramp up in such a short period of time. So it's not a matter of whether production can keep up because we think it can, but it will be on its back foot a little bit going forward. And you can see there are assumptions for calendar year 26, about 30 cents oversold, and in summer of 26, about 35 cents oversold. So be ready for that, especially if you're a gas buyer.
I think, Jack, it's worth noting that from a producer perspective, it's absolutely better to be on the back foot than ahead of their skis.
Oh, sure. Yeah. That's good terminology. We should note that ski season in Colorado here opens up in about 3 weeks. So come visit. That's exciting. Although early season conditions. Anyway, so what do you got here on NG3? This is big news leading into winter.
Yeah, thanks, Jack. So Yeah, big news. NG3 is in service and already flowing over half a BCF a day, just on day one, actually. So, why does this matter? Well, first off, Expand Energy, the largest producer in the Haynesville, is signed on as an anchor shipper and holds a 35% equity stake in the project. Momentum Midstream is also very well positioned to take advantage of growth in the Arklatex as a whole, and in particular in East Texas, where they have by far the most extensive gathering footprint. Throughout this year, we've observed a significant amount of exploratory drilling in East Texas without an associated increase in volumes. And so we do expect there's a large wedge of deferred production just waiting for LNG demand really to turn online. As you can see on the chart on the right, Williams Louisiana Energy Gateway Project, which turned online in July, is also ramping quickly, and DTM's LEAP is approaching max capacity of 1.9 BCF a day, where historically it's flown at around 65% utilization. Gulf Run volumes are slightly down, but we don't expect that to last with Golden Pass LNG just around the corner. Golden Pass holds more than 1 BCF a day of commitments on Gulf Run. We also got some new news this week. ARM Energy made FID
and PIMCO.
And PIMCO, yeah,
Yep.
I'm sorry. Made FID on the 2.5 BCF a day Mustang Express pipeline, which will move Permian volumes from Katy Hub to Port Arthur, where it'll primarily support Port Arthur LNG's phase 2, so another 2 BCF a day project there, which made FID last month.
One thing I thought was cool about that announcement that we saw yesterday was this project, along with the Energy Transfer's Desert Southwest project, both made FID before they held their binding open seasons, which isn't typically how things go. But I think when you have an anchor shipper like a Sempra, right, you can move forward pretty confidently. Obviously to finance your project. So the open season for Mustang will be announced, I think, shortly. I think they said maybe next week. And so go kick the tires, check it out. Give that Stang a little test drive, if you may. That's bad dad joke. All right. Well, Oren, okay. Any further commentary, or are you?
No, I think you covered it.
Okay. Cool. All right. So, on that bad dad joke note, let's get on to crude NGLs and capital market winners with Gage, Julian, and Jackson, respectively. Gage, you're first.
All right. Well, I think the big thing that I want to note here is this is a slight revision from our discussion of last month.
But not our revision, right,
Not
Gage? Okay.
So, in the chart on the right, our total U.S. production against the EIA's. The kind of tealish color is our forecast, and then the orangish red color is the original August steel production figure. And on top of that is now the October revision for U.S. crude production. So back in August, the EIA came out stating that production was going to peak in the United States at 13.6 million barrels a day in 25 and would then decline down to 13.2 million barrels a day by year end of 26. That has since been revised, and the EIA is now forecasting that production will average 13.5 in both 2025 and 26.
That's a very familiar forecast.
It is quite familiar. So it's important to note, I think, here that with the EIA revising their forecast, that ultimately the market is realizing that with all of the new gas build out of the Permian, where most of this U.S. production will come from, that production will need to come online in order for the associated gas to fill the gas pipelines.
Right. Yep. And there's a couple big ones in 26. Blackcomb itself is a 2.5 BCF a day whitewater backed project. and then GCX has a 0.5 BCF a day expansion. So there's going to be, I guess, some demand or capacity pull there on the gas side of things, and that'll kind of steady any potential decline in crude. So awesome. All right. Well, Gage, any final thoughts? No. Okay. All right. Well, that was awesome. Like I said, the kind of fuel commodity dynamics are large and in charge here, and that's why we forecast all three commodities at once. All right, Julian, you got some exciting winter news here, and also another pipe project to talk about.
Yeah, thank you, Jack. So we'll talk about Targa's new Speedway pipeline, just kind of how's that changing the Permian, a little bit about, adding more color to what Maria was saying about the Permian growing and what that kind of means for, that propane and just NGL overall winter outlook. So Targa came out, announced a new NGL pipeline, 500 MBD, $1.6 billion, connecting Permian to Mont Belvieu, and they're really citing their getting constrained Grand Prix into Mont Belvieu. But what's kind of interesting about this pipeline, it comes at a time where there is a lot of extra underutilized pipe space. I mean, if you look at the
blue line, yeah,
that is the total capacity. Currently there's about 4.5 speedways of free capacity. So when you kind of look at that, you're kind of saying, okay, well, why? What's the need for another pipe? Why are you building another pipe? And really, for Targa, I think they're the only company that can do this, and that's simply because they have the most gas processing in the Permian, and they're able to source their own volumes to fill their own pipe. So this is an all right move for Targa, filling up their own pipe. There is some downside risk there. You can check our GMP allocation tool to check Targa's gas processing in the Permian. We're tracking all those new plant builds, and if you do look at that tool, you will see that there is some kind of gaps of, maybe those plants don't fill as much as they say they will.
And does Targa have obligations on non-Targa pipelines that expire before they build Speedway?
So that's a good question. They do use some third-party pipelines currently. I'll have to get back to you exactly the details, but I know they do.
Okay.
I'm not sure exactly when those contracts roll off.
Right. Either way, it's profitable for them to be completely integrated from the wellhead or from the processing plant down to the coast, right?
And Target does cite around 200 MBD of, they'll be able to fill around 200 MBD of the 500 MBD just from their announced and FID already gas plants. Again, kind of the downside there is, are they able to fill those gas plants?
Gotcha.
And then kind of finally just touching on the winter outlook, adding some more color here. I think that really the standout thing here is the propane out of the Permian. We have seen just higher propane in pad 3, kind of propane balances, above the 5-year average. And, this is going to put some downward pressure on those propane prices, which I think does have to happen. We've seen kind of international arbs close, especially with Aramco coming out and saying they're lowering out their propane and butane pricing, kind of changing some of those trade flows. So really, the Mont Belvieu price is going to be under a lot of pressure to get lower if we want to export some more barrels. But kind of the other side to that is the winter kind of domestic propane demand. If we do see a colder winter, propane prices will go there.
Some more crop drying in the upper Midwest.
Yeah, and we have seen a stronger crop this year, so there's some upside there as well to kind of domestic propane demand. And then finally, just on ethane, we have seen ethane prices rise since August, around 8 cents. They were around 21 cents, they're now around 28 cents per gallon. So when we are looking at winter frac spreads, we usually see more rejection due to higher gas prices. We're just going to need a higher gas price than you would have needed previously.
Okay. Well, I think we do have that in the forecast. Mm-hmm. So we'll have to see how that balances out with rejection levels.
Right.
So, all right. Cool. Well, very informative as usual, Julian. Let's go to kind of our last presenter here. He's been anxiously waiting, chomping at the bit, if you will, so allow me to say. But Jackson, what is going on here? This chart just looks like it's gas production, so I'm assuming you're going to bring some light to it.
Yeah. So at a high level, Jack, right, what you're talking about with massive amounts of LNG and data center demand, these key basins like the Arctic and Permian, as we're seeing, are growing pretty quickly here to meet that demand. So first off, in the architects, we're expecting like key companies that are positioned and gas weighted within the basin, like Kinder Morgan through the Kinderhawk system, which is up 23% quarter over quarter.
Yeesh.
And they're already expanding another $500 million into it,
Mm-hmm.
with key producers like Comstock behind them, as well as Williams with their Trace acquired system, which they're expanding from 1.8 to 4 BCF a day, and that can directly feed into their leg pipeline as well. DT with Blue Union and their LEAP infrastructure, as well as Energy Transfer and with adding 3.4 BCF a day. Sorry, with 3.4 BCF a day of capacity across 12 plants.
They're like East Texas and
Yep.
all that. Yeah, that's an incredible array of
then-
assets they've got up there.
And then onto the Permian, like what Julian's talking about with Targa, with the largest amount of processing capacity and more coming online, multiple BCF a day, very quickly here as they're ramping to meet the LNG demand and fill their NGL pipes.
Yeah.
With all of that latent capacity that we're seeing come out of there. Kinetic with about 2 BCF a day integrated in the northern Delaware, and then a couple players like Targa's following this, and MPLX and ONEOK all following the wellhead to water strategy, trying to get those NGL barrels on their pipelines and riding this ramp
Gotcha.
through these basins.
So it sounds like, being commodity agnostic here, right? If you're in those basins, especially the big dogs there, Permian, Haynesville, Eagleford to a certain extent, then and you're gas weighted, then you're in pretty good shape.
Absolutely.
Okay, so those are the names, those are the symbols across upstream and midstream that you might want to be on the lookout for. Cool. Okay, and as usual, if you want, midstream equity company briefings and earnings previews, right? You can find those on the East Energy Data Studio portal through East Daley. So, we love midstream here, obviously. So cool. Thank you, Jackson. All right. Last but not least, we're going to very briefly go over monthly production trends and totals here. With crude, thing that stands out most to me is the continued, month to month increase in the Permian there. Maria, I think you kind of covered this earlier. So,
Yeah,
Yeah.
I mean, as you notice, like we have production outlook for the different basins for the three commodities. Like if you keep going, you'll notice there's variation across basins reflecting the unique dynamics in each region. Our forecast incorporates assumptions on commodity prices, rig activity, and IP rates, as well as input from plant data, pipeline sample, and producer guidance. And together, these points allowed us to deliver the most accurate and timely production outlook on a monthly basis.
They certainly do. And that is just another reason why, if you're not a client, we'd like to talk to you. So don't hesitate to reach out. All right. Well, that concludes our chat here, our webinar for the month of October. To get the edge, the insider, the burner tip, fundamentally speaking, or the daily note, click on those QR codes or take a picture of them, and you'll get set up there for even further ongoing insight. On behalf of myself, Gage, Jackson, Julian, Maria, and Oren, thanks. This has been a really great use of time, and appreciate all of your contributions.
Thank you, Jack.
Thank you,
Thanks,
Jack.
Jack.
Very good. And lastly, thank you to our audience members, and we will see you in November.